Well, in FinStreet today, let's focus on the loan growth, which has been phenomenally strong for the banking sector in FY23 so far. So, for the period ending 27 Jan 2023, credit growth was at 16.3% YOY and non-food credit growth was 16.7% YOY. Let's take a deep dive into what has driven the loan growth and how will it pan out going ahead. Incremental loan growth, non-food credit for FY23 up to Jan 2023 has been at rupees 14.6 lakh crore. Monthly basis, the credit demand for up to Jan 2023 has been around 1.46 lakh crore, which is better than the previous high of 1.4 lakh crore that we saw in FY20 and one of the best in many years. Now, which sector has driven the loan growth? Personal loans, which includes home loan as well, has been one of the biggest drivers of loan growth in FY23 so far. Services has been the next best segment to witness strong loan growth momentum. It formed around 31.5% of the incremental loans in the system up to Jan 2023. Agriculture formed around 12.1% of the incremental loans, with industry forming around 9.4% of the incremental loans. Now, talking about the best performing segment, personal loans. Of the incremental loan growth of about rupees 5.7 lakh crore in personal loans, it was around 35.55% share, which has been driven largely by the housing sector, which includes priority sector lending as well. And second large part was from another personal loans, which contributed around 30% of the incremental loans. Vehicle loans and credit cards have done well too. Credit card performance in FY23 so far has been one of the best in the history for banking sector with respect to outstanding loans, card issuances and massive increase in ticket sizes as well. Now, services sector performance has been good too. NBFCs switched to banks from money market as liquidity dried up over there and money market rates also shot up. Trade also performed a substantial portion of the incremental loans in the services segment. Shipping witnessed a decline in terms of incremental loan flows. Let's take a look at the outlook. So, loan growth rate will soften a bit going ahead. Some part of the loan growth has been derived from lower principal repayment. Hence, when the repayment of principal in the EMI starts to increase, we may see some impact on loan growth as well. Capex demand is yet to come back from the corporate sector. It may not be back in a high inflation rate scenario. Corporate loans may continue to see working capital kind of demand from lenders due to better interest rate than money market instruments. We can expect personal loans to continue driving the overall loan growth momentum for the banking sector. NBFC demand will remain healthy due to favorable interest rates from banks than other instruments.